My name is Dolores Brown. I'm the Retirement Benefits Counselor at AFSA. Welcome. I retired from the Foreign Service in 2018. I see some familiar names and faces out there. My last two jobs in the Foreign Service were DCM in Estonia, and then I was the management counselor in Cairo. I started out as a GSO in South Africa. I'm very happy to be working at AFSA on these issues that are near and dear to me. And I just want to underscore that I'm there for you. And if you have any questions or suggestions or anything of that nature, please don't hesitate to be in touch with me. It's easy. My email is brown, like the color, brown@afsa.org. So I really do look forward to hearing from people. I just wanted to give a little pitch for our AFSA's retirement directory that every retired member should have gotten in December of last year. The reason I'm bringing this up is that I get a lot of questions. Where do I get my 1099? How do I change my insurance? And this actually has a whole bunch of information in the beginning that is valuable, including who does what, with all the telephone numbers you may need to call and get those kinds of answers, or verification of employment, if you're refinancing a house or want to change your FEHB, or many, many things. So this is something people just don't kind of put this to the side and they use it to call their friends, but there's a lot more to it than to that. So I thought I'd let you know that you have that resource right at your fingertips. Let's get to the Zoom. I'm glad to welcome you all to this Zoom. It's on the Federal Long-Term Care Insurance Program. It's the second program we're having this year in AFSA's Federal Benefits Series. The program will be divided into two sections. The first section will last about 15 minutes, and it's on long-term care planning. So it's kind of a chapeau, an overview of what you should be thinking about when you are thinking about long-term care. After that first 15-minute segment, we'll stop and we'll take questions on that part of the program. Then we will go on to the second part of the program, which is again going to be about 15 minutes long, and it's going to be on long-term care insurance, specifically the federal program. And then we will take a series of questions again. I'd like you to submit your questions through the chat function. I will triage them and take as many as I can, try to make them as general as possible so that they will benefit the entire audience. If there's something very specific, you're welcome to email me and I can work with Nathan to get you an answer later. But for the purposes of this program, I like to ask general questions. We're a big crowd, so you're muted. I'm sorry. It cuts down on ambient noise, the dogs barking or whatever. So that just helps everybody with the program. And if for any reason you need to drop off this presentation, it's important to know that we post all of these presentations on afsa.org. So if you've missed one or you have to drop off, you can always access it later. There's a lot of good information on afsa.org, and because you kind of have to dig through the website, I'll just mention again that we have all the presentations, John Nayland's that go back on retirement planning. We have them from Paula Jacob, who's the head of the Foreign Service, American Foreign Service Benefit Association, and so on. So there's a great deal of information on afsa.org under retirement services, including all DACs from the department, including information about Medicare B and how to coordinate it. So we really take pride in keeping that information fresh and up. So I just wanted to mention that to you. So with no further ado, I would like to introduce Nathan Siebert. Nathan is a senior account manager at Long-Term Care Partners, which is the organization that oversees the Federal Long-Term Care Insurance Program. He is a certified long-term care insurance consultant and a long-term care professional. He knows his stuff. So he will introduce us to the various parts of the OPM program and also give us a a good advice about what to think about when we're thinking about long-term planning. So please, Nathan, thank you for being here. Thanks.
Well, thank you so much for having me. I'll just do a quick check that you guys are actually able to see the slides once we get them up and running. Does it look pretty good on your end?
I see it.
And you can see me this time, so that's also an improvement from our test last week. Great. Well, thank you everyone for taking some time today, and I certainly appreciate you joining us. My name is Nathan Siebert, and I work for the company that administers the federal long-term care insurance program. Like Dolores had mentioned, I am in fact a certified long-term care consultant, a long-term care professional, certified senior advisor, but I always like to take a quick break and just remind folks what I'm not, and that is a salesperson. So I am not here to sell you any long-term care policies today. Really what my goal is to educate about long-term care and where long-term care insurance might fit into your retirement planning. So within those two goals, I kind of break the presentation down into two parts. And the first part is just talking about what long-term care is. Just want to make sure we're all on the same frame of mind about the type of care we're talking about, what's going to pay for this style of care, probably more importantly, what's not going to pay for this style of care. And then once we agree that we're all talking about the same care, that's when we transition to talking about long-term care insurance, and specifically the Federal Long-Term Care Insurance Program, or FLTCIP, how it's different than private plans, how it's the same, how you build and design your plan. And I'll also give you some resources at the end as well for any additional questions that we maybe don't hit during the presentation. So first things first, I'd like to talk about what long-term care is, because there's still some confusion out there with the terminology. So we are headquartered in Portsmouth, New Hampshire, and in non-pandemic times, I travel all over the country to give my presentation to different federal agencies or affinity groups about long-term care. And folks back home always ask me, what is it exactly that you do? I say that I educate about long-term care. They kind of look at me funny because they've heard the term, but they don't exactly know what it means. I say I can make it even easier for you. The type of care that we educate about is what they call custodial care, helping with your activities of daily living. So if I was doing this presentation live for you today, I'm assuming it would not be in Portsmouth, New Hampshire, so I'd be traveling somewhere. I'd be in a hotel, but my ADLs would be the same as if I were home. Things like getting out of bed, transferring, taking a shower, bathing, putting my suit on, dressing, having a little breakfast, eating. If I need help with these types of activities, well, that's what long-term care is, again, or also known as custodial care. Now, some folks might be able to accomplish these tasks, but they have to be either supervised or reminded because of a cognitive issue. Something like Alzheimer's or dementia, that's also long-term care. Where does long-term care take place? I've been with the Federal Long-Term Care Insurance Program now. This will be my 15th year. And I started as an inbound phone rep, answering question after question about long-term care. And folks would call me up. They say, can you give me some information on that nursing home insurance that you offer? And I could certainly help them. I knew what they meant. We might associate long-term care with facilities like assisted living or nursing homes. But the fact of the matter, in this country, the vast majority of long-term care, it actually takes place in the home. And most of the time, that care is provided by unpaid caregivers. Who's that? Generally, it's family members. So my story, my family story with long-term care was a situation I went through with my grandfather. My grandfather was a World War II veteran, greatest generation, very proud Vermonter. He went to Europe to fight the war, came back to Vermont, and I don't think he ever left again. But later in life, my grandfather developed dementia. So my grandmother decided she was going to handle this problem, which she'd handled every other problem in the 50 years before. She was going to take care of him. She was going to take care of him in-house, and she was not going to ask for any help. They'd gone through a world war. They'd gone through a flood. They'd gone through 55 some odd years of marriage. She could handle this. Well, about 6 months into this process of my grandmother being my grandfather's full-time caregiver, my grandmother got sick. Did not get a specific diagnosis. She got old age. She became frail. And the reason was because of the stress of providing that care for her husband. And the reason that I share my family story is that a lot of these presentations that you hear about long-term care really focus only on the financial aspects, which we are certainly going to talk about as well. But if you haven't gone through a situation, just might not be aware that there's also a physical and an emotional toll for long-term care, and not just for the folks that need the care, but their family and their support system as well. So why are folks planning for long-term care? The simple answer is people are living longer, and the longer that you live, there's a higher chance that you're going to need long-term care. HHS estimates around 70% of folks that reach the age of 65 will need this style of care in their lifetime. And not only is long-term care expensive, which we're going to see throughout the presentation, but what we're also going to see is that there's not a lot of benefits that folks already have in place that can cover these types of costs. So first things we talk about are just, what benefits don't cover long-term care? Because this is probably the question I get most often. Folks think about long-term care and they say, wait a minute, I have this great FEHB program. I'm going to be able to retire with my FEHB program. Why do I have to plan for long-term care any differently than I plan for any other health issues? Well, it's probably a separate seminar for us to discuss whether or not health insurance should cover long-term care. The fact of the matter is, it does not. And it doesn't matter what health insurance you're talking about. If you have an FEHB program, if you have TRICARE or TRICARE for life from a uniform services background, if you have a spouse's private health insurance, or if you're 65 and have Medicare, these are all health insurance that do an excellent job of covering what they call skilled medical care. I go to the doctor, I go to the pharmacy, I go to the hospital. Health insurance does a great job covering that. But what health insurance doesn't cover is those costs of custodial care, care that's designed to help you with your activities of daily living. Now, some of these benefits, and especially Medicare, does offer a short-term rehabilitative benefit, but the key words here are short-term and rehab. So typical Medicare claim for a rehabilitative care is less than 25 days. It's not really a long-term solution. And the other word here is rehab. So once you're no longer getting better from your condition, your health insurance says that's no longer our problem. So my grandfather had to be in a facility towards the end of his life, but he wasn't going to be rehabbing his dementia away. Therefore, his health insurance, his Medicare, didn't cover any of those costs. Now, there are a couple of federal benefits that do cover this style of care, but I only work with the federal long-term care insurance program. So my audience is only federal employees and retirees. In fact, the audience probably won't qualify for these benefits. So Medicaid, not to be confused with Medicare, but Medicaid is the state and federal plan. It's designed to help folks that live on or below the poverty line. It can vary a little bit state to state, but in general, we're talking about assets of around $2,000 or less to qualify. Typically it covers nursing home care and nursing homes that accept Medicaid patients. And folks would need to spend down their assets first to qualify. If you have more than $2,000, Medicaid says that's great. Come see us when you have $2,000 or less. Most states also have what they call look-back periods. So you might have heard the terminology Medicaid planning. Medicaid planning is a way for me to take assets out of my name so that if I need this type of care, I can qualify for Medicaid. I don't have any assets. Well, the states kind of got wise to this and said, this is strange. People who have never qualified for Medicaid their whole life are now qualifying at the exact time they need this expensive custodial care. So most states will look back at least 5 years. And any assets you've moved in those 5 years, they still think you have access to. You have to wait that time penalty first to qualify. But I think the last bullet might be the most important for my audience. Because when a lot of the general population is thinking about Medicaid planning and long-term care planning, they're only thinking about assets. But as a federal retiree, the great thing about being a federal retiree is that upon retirement, you're going to receive your annuity, your pension. The fact of the matter is, for the vast majority of feds, you're probably going to be making too much money in retirement. Think about qualifying for Medicaid regardless if you have assets, but most feds also have assets, through their different retirement planning accounts. So it's an important benefit. Most federal employees or federal retirees are probably not going to qualify. VA is another federal benefit that does cover some custodial care costs. But again, not for all veterans. The VA will cover custodial care or long-term care at a VA facility for veterans if that veteran has a high service-connected disability of at least 70% or greater. So, the veteran might still be going to the VA facilities to get their health checkups, or their eyeglasses, but the idea of retiring to the old soldier's home on the hill doesn't really exist in today's VA unless that veteran has a high service-connected disability. They're also going to look at your ability to help cover those costs yourself and available funding, meaning is there literally a bed available in my area? The VA also offers an aid and attendance benefit to wartime veterans and spouses who can receive care in their own home, but that is also income and asset level based. My population that I talk to, probably their income and assets are too high for aid and attendance, but I do like to share the information in case someone has maybe family members or friends or neighbors that have made some different financial decisions in life. Long-term care is expensive. This is from the John Hancock Cost of Care Survey that was released in December of 19. Metro DC around $111,000, $112,000 for nursing home. Orlando, Florida, Phoenix, Arizona, a little lower, but because of the higher population of elderly folks, but still $98,000 Orlando, $83,000 in Phoenix. Northern California, to no one's surprise, $120,000 a year. But even someplace like North Dakota, there's just not a lot of facilities in the Dakotas. Therefore, it's one of the more expensive places in the country to receive care. So when you look at these maps, a lot of folks will just say, well, can your retirement handle these costs? And I think that's probably the most valid question. But the second question that I typically ask is, well, is that what you want your retirement to do for you? You've all worked really hard so that upon retirement, you can live a certain lifestyle, spouses can live a certain lifestyle, we make promises to kids or grandkids about weddings or educations. Can I fulfill those promises if I'm paying these out-of-pocket expenses? That's where long-term care insurance fits in. It's insurance. So I'm paying a premium now so that down the road, if I have a need for care, the insurance is going to help defray those costs. And what I think personally is the most important point about long-term care planning for the vast majority of us is that having long-term care insurance allows folks to stay at home as long as possible, what they call age in place. I think that should be the goal, whether you choose an insurance product or not, but your goal in retirement planning, if that's your desire, should be to set up so that helps you stay at home. So that's when I was talking at the beginning about folks asking about nursing home insurance, and absolutely this will cover costs there, but it's not nursing home insurance. Insurance that's designed to help folks stay in community-based care, allowing folks to protect their retirement savings, reducing family member stress. Long-term care is always going to be a stressful time, but having a plan is probably the most important thing that help alleviate that stress. So before we take a quick break for questions, I just wanted to bring up a couple other solutions. One of the nice things about how the federal plan is set up is that none of us work on commission. So I can give these presentations and be fairly honest about the pros and the cons, hopefully, of long-term care. I don't want anyone ever leaving my presentations thinking that they just sat through a sales pitch. I want you to understand how your federal benefit works, but it doesn't make sense for everyone. So standalone long-term care insurance is what the federal plan offers. So we'll talk about that in the next portion. Another big thing that we're seeing in the industry now is what they call combo products. A combo product is a life insurance with a long-term care provision built in, meaning that you can use your life insurance benefits before you pass if you have certain medical conditions. The not so fun insurance term for this is that is an accelerated death benefit. So if you're looking through your paperwork, looking through your small print, if you see that, then you might already have a combo product built in to your life insurance. Continuing care retirement communities, or CCRCs. Really what the CCRCs do is they kind of provide a continuum of care. It's one physical location where someone can move into, and then as their need for care changes, they can move to different locations within that facility or within the campus or on the grounds. These were very popular probably 10 to 15 years ago. Still popular now, but the issue that you run into with CCRCs is pricing. When they originally came out 15 years ago, you paid one price up front for most facilities. And then as your needs for care changed, you didn't pay any more because you'd already paid your upfront fees. They found that a very challenging way to pay for these, and that some of them are literally running out of money. So now the typical solution is that you're paying still some upfront fee and then probably a monthly fee in addition. And as that need for care changes, so doesn't that cost structure. So a lot of fine print, but a real powerful tool if your goal is to sort of stay in one area. The last one that I talk about or touch on in this slide is reverse mortgages. I kind of like to say, well, that's one thing that you would do if you didn't plan for long-term care, using the value of your house to help cover your care needs. Can be an important tool. Some folks maybe have a lot of value. They don't have anyone that they wanted to leave that house to. They weren't going to leave it to their church. So it's another arrow in the quiver for figuring out your long-term care plan. My somewhat snarky stipulation, though, is that just because we all loved, watching Magnum PI on TV, when he comes on your screen on TV to sell you reverse mortgages, just make sure you're going to a reputable bank, a reputable carrier. There's a lot that goes into reverse mortgages. So Dolores, I think we'll take a quick pause here, and I'm happy to answer any sort of general long-term care questions before we transition to long-term care insurance.
Okay, I have one that's a perfect foreign service question.
Okay.
Do any long-term care insurances in the States provide coverage if you retire or live outside of the United States?
So the question is, I know at least one, and that would be the federal plan. So yes, we will talk about international coverage for long-term care insurance. I would imagine that there are other long-term care insurance plans that do cover international coverage. And probably this is a group that knows better than I, but I've done a lot of different retirement presentations at FSI. And what I hear talking to folks in the hallway after my presentation is that international care generally is a lot less expensive than care in the States. So I think that a lot of insurance companies probably would take that on because it's less expensive. But yes, the federal plan for sure covers international benefits. We will actually discuss that at a later slide.
Okay. Here's an interesting one. What are the best rating resources to help select a facility?
I think when you're looking at facility care, the best thing that you should do, or that you can do, whether it's for yourself or for a loved one, is start with your state's Department of Aging. Every state has a Department of Aging. Every state has a list of facilities and what their ratings and scores are. Everyone's going to have a different individual situation. Two people in the same facility can have very different experiences. But I think the best place to start is your state's Department of Aging. HHS, both at the state and federal level, typically have some resources for finding care providers. I'll talk about the resources that the federal plan also offers in addition to those for finding and locating care providers as well.
Okay. Do you think, Nathan, that CCRC prices will come down as boomers age or die out?
Well, I think it's, so the first answer is, I don't know. And I think that as medical science allows folks to live longer and longer, it does not always mean that we live healthier and healthier into old age. So my guess is that as people continue to lengthen aging, you're also going to see some additional costs. The other thing that I think it's important to remember when we think about the baby boom, because we actually get this question a lot about the baby boom, or some variation of this question. And if you look at our country. And if you look at birth rates sort of on a graph, it is not a hump. The baby boom was a start of something, and it's been fairly level after that. So population has not decreased. So there will be another generation that comes behind baby boomers that is not that much smaller than the baby boom. So I think in our minds, we kind of picture a big U, but that's not actually the case if you sort of look at the population graphs.
Okay, I'm not sure whether this question better belongs in the planning or insurance part, so I'm just going to go and do it. One of our listeners asks, I heard there's going to be a federal long-term care program iteration number 3. Will you discuss? And how certain are we that the plan will be around when we need it?
Sure. We're actually going to cover most of those points, but I think the important thing to note as we talk about long-term care insurance going forward from this part is that we are actually currently in the 3.0 iteration. So we are in long-term care for the federal plan, the 3rd iteration of it now. So what we talk about today is the current offering and is the 3.0 version. We'll talk about how the federal plan is set up, how it's set up differently than private market plans, and some of the additional protections that an OPM-sponsored program offers you.
Okay. We have a number of additional questions, but I think that some of them will be, I think they will be answered by the second portion of your presentation. So we'll go there, and then, you know, I could also ask them at the end if maybe you would further elaborate. So
absolutely. So if there's anything we don't hit, let us know. And we'll make sure that we get done really close to the 1 o'clock. I'm sorry, 2 o'clock time frame as well. I don't want to keep folks too long, but I want to make sure we get all the questions answered. So I'll speed through some slides, but I'll make sure that we hit on all the important topics.
Okay.
So actually kind of a good segue to the question about the 3.0 and the different plans that are out there now and if we'll be there in 20 years. Is I think it's important to note, if you're shopping for traditional long-term care, which the federal plan is, standalone long-term care insurance, the vast majority of plans being sold today are going to be fairly similar. There is not a huge variation in what's being sold in the private market versus the federal plan. And that is because, you know, 15 years ago when I started, there was a lot of insurance providers that were selling long-term care insurance. It's not the case now. It's really streamlined into a few carriers who sell typically group long-term care policies, which the federal plan is. The biggest change I've seen in my 15 years is this idea of comprehensive coverage. Comprehensive coverage simply means that you can decide where you receive your care, and you can decide when you have that need for care. You don't have to decide when you purchase. So 15 years ago, you could buy a facility-only plan or a home care-only plan. But I don't know what my level of care is going to be in 20 or 30 years. Why would I pigeonhole myself into one style? So now everyone offers comprehensive, and that simply means you can receive care either at home or in a facility. But probably the biggest benefit difference between federal plan and the private market plans are how we offer home care. So everyone is pretty much offering comprehensive coverage, so everyone's offering home care. But most plans that you buy in the private market, in fact, I believe all of them, will offer you what they call formal caregiving. You pick up the telephone, you call a home health agency, they send a licensed professional to your home. We also offer that. But what the federal plan offers in addition is informal caregiving. That means that you can hire someone who's not a licensed professional to be your caregiver. It can be a friend, a relative, a member of my church, a neighbor. Oftentimes folks that might be there to help and support us anyways, they can get a financial benefit now at being your paid caregiver. And they do not have to be a professional caregiver. You know, my niece can provide care for me. My friend that lives down the street can provide care for me. Only stipulation with informal caregiving is that family members are capped at 500 days they can provide care for each enrollee, and that if that person would normally be living with you at the time your care needs start, then they cannot get a financial benefit. So a spouse can't get a financial benefit for providing care for a spouse. Take it from my grandparents, that's kind of why you have long-term care insurance, so your spouse doesn't have to be in that situation. Now, my niece could move in with me after the fact, and I could still pay her because she wouldn't normally be living there when my care needs started. So designing your plan. There's one umbrella of federal long-term care insurance, but within that, there's different amounts of coverage. So you're going to build a plan that makes sense for you and your family. You do that by choosing a daily benefit amount, a benefit period, and how you protect those two things from inflation. And as I think I mentioned during the QA portion, the benefits that we're going to talk about going forward are the 3.0 iteration of the plan, FLTCIP 3.0. So if you bought a plan prior to last October or October of 2019, your DBA, your benefit period, your inflation prediction might be different options, but this is currently what's being sold. And the other thing I'll say about this is that, if you are shopping around, and you absolutely should shop around for long-term care coverage. You're buying a policy that I hope you never use, but if you do use, it's going to be down the road. So you want to make sure that you're choosing a policy that best meets your needs, whether that's the federal plan or not. But this is how you design long-term care: benefit periods, daily benefit amount, and inflation protection. So it's good info, even if you maybe decide to go with the private market. So first thing is daily benefit amount. We go between $100 and $450 per day in $50 increments. And this is what the insurance company would pay for your care, regardless of where you're receiving that. So you can use 100% of that daily benefit amount in a facility, 100% at home, or like was brought up earlier, 100% internationally. When you're thinking about daily benefit amounts, our last bullet here says consider the cost where you live. I think the better way to say that, though, is consider the cost where you think you might use the insurance. Because while the plan works exactly the same all over the world, what does vary is the cost of care. So I gave this presentation a couple years back to a federal executive board in Kansas City. And I said, in that room, if you folks tell me that you're going to retire in Manhattan, Kansas, I probably would say that you might want to look at a different daily benefit than someone who retires in Manhattan, New York. Why? Because the cost of care will be different. We have a cost of care tool on our website that does list, unfortunately, all the costs in the US. So you just put your state, nearest metropolitan area, and it'll tell you what the rates are for nursing home, assisted living, and home care. If you have a question about international, you can give us a call. We might have had that question before. We do have some additional resources over the phone, and I'll certainly share that phone number. But just think about, where you might be using the policy, because there are some parts of the country where the cost is significantly less. But if you're thinking about moving to Alaska or Hawaii or Northern California, well, the cost of care is significantly more there. I might choose a different daily benefit. Next decision you make is benefit period. We offer 2 years, 3 years, and 5 years. And this is without a doubt the most confusing part about long-term care insurance and building your plan. And the reason that it's confusing is this terminology of benefit period. In our defense, it's the same terminology that every insurance company uses. But I really dislike the terminology because I think it adds a level of confusion that doesn't need to exist. So what I like to do is actually show you how it works first, and then talk about why someone might choose 2, 3, or 5. So how your benefit period works is it's actually a benefit multiplier. So if someone tells me that I have a 3-year benefit period, my first assumption is that I have coverage for 3 years. That is not how it works. So I've chosen a $150 daily benefit amount and a 3-year benefit period. I multiply 150 by 365 days in a year, and then by 3. Gives me a pool of money, $164,000. I will receive my benefits until I fully exhaust this pool. So if my niece is providing care and charging me $75 a day, The other 75 stay in my pool to be used at a later date. So my 3-year benefit period could last 4, 4.5, 5, 6 years. What's important is how I spend down this maximum lifetime benefit pool, not a specific time frame. So again, it's a little confusing. It's where we get the most questions, and I get why we get the questions, but I just have not reached the level in this company where I can start naming things, but hopefully someday. But 2, 3, or 5 years are your choices. But just remember that those are not time periods. They're multipliers to give you a large pool of money. Now, why would someone choose 2, 3, or 5? Industry-wide, and including the federal plan, the most popular option for long-term care insurance is a 3-year benefit period. If you are looking at a Hancock private plan, a Genworth private plan, a Mutual of Omaha federal plan, they are going to all tell you the same thing. 3 years is our most popular option. Well, the natural question is, why is that? And I would say, well, my guess would be, my educated 15 years in long-term care guess would be that, well, someone sat down and they told them this statistic, which is in the US, the average stay in a nursing home, it's about 2.5 years. And that's absolutely correct. That's the average stay in a nursing home. Well, that's important. However, if we were in a live seminar, this is where someone would raise their hand and say, 2.5 years, my mom was in a facility for 15 years, or my dad was in a facility for 6 months. So I think probably what's more important when you're thinking about a benefit period is less about what the nationwide average is, more about what your own family history is. You know, none of us know what the future holds, but if we have 4 grandparents that lived to 102 years old and never needed a day of care, I might choose a different benefit period than someone who unfortunately has a strong family history of something like Alzheimer's or dementia or MS or Parkinson's. Last decision you make is inflation protection. So you've chosen a pool of money, and you want to make sure that pool of money is going to make sense for you when you need your care. So you have 2 ways to cover inflation: an automatic inflation option or a future purchase option. How the automatic inflation option works is that every year on the anniversary of your purchase, your daily benefit is going to increase by 3% compounding without a corresponding increase to your premium. So if you choose the automatic compound inflation option, you're automatically increasing your benefits every year. The other way you can protect from inflation is what we call the future purchase option. This is more of a pay-as-you-go model. So with the future purchase option, you start out with a much lower premium, and we'll look at premium in the next slide. Then every 2 years, you'll receive a letter. The letter will say, well, the actual rate of inflation has been X%. Would you like to purchase an additional amount of insurance to keep up with that? If I say yes, I'm buying more insurance. Therefore, I'm going to see an increase in my benefits and an increase in my premium. So I like to think of this again as the pay-as-you-go model. You do not have to take the increases. You can decline them. If you decline them 3 times, we will stop sending them to you, but you can always just show proof of good health to have those resumed. So long-term care insurance, whether it's a federal plan or a private plan, the rates are based on your age at time of application, as well as the amount of coverage that you choose. So I like to show some examples of premiums because I think it helps with the understanding of how the inflation works, or excuse me, the inflation protection. So the first column is the 150 daily benefit amount that we looked at on the earlier slide, 3-year benefit period, 164 maximum lifetime benefit. And you can see at age 40, 50, and 60, and 70, it is much less expensive with the future purchase option. How come? Because that does not have a built-in increase to your benefits. You have to buy more insurance if you want to keep up with inflation. I show 40, 50, 60, and 70 to give you guys some idea of costs, but every age has its own rate. So 40 is different than 41, different than 42. It's also important to note when you're looking at whatever you've chosen for an inflation protection, As your daily benefit increases, and your daily benefit works with your benefit period as a multiplier, your maximum lifetime benefit pool changes as well. So I buy $150 today, in 30 years it's worth $364 a day. Therefore, my maximum lifetime benefit has gone from $164,000 to now $430,000. So both my pool increase and my daily benefit, regardless of which option for protection I choose. Each plan also has a waiting period. A waiting period may be called an elimination period in a private market plan. I sort of think about it as your deductible. So how long-term care insurance works is that you can purchase long-term care insurance with the federal plan at any time, not an open season benefit. You'll fill an application out, we review your medical records, we determine if you're eligible for the insurance. Once we determine that you are fully vested in your program day one of the next month. So if I apply today, early in March, and I get approved on March 27th, as of April 1st, I'm fully vested in my program. Down the road, once I have a need for care, my healthcare professional certifies that I need assistance with at least 2 of the 6 ADLs, which are eating, dressing, bathing, transferring, toileting, or continence, or I need that supervision because of a cognitive issue that starts my clock. It does not matter if I incur any expenses during that time, but if I do have expenses in my 90 calendar days, it is an out-of-pocket expense. I don't know if it's a pro or a con, but if you're looking at private market plans, they will probably offer you some additional choice here. They may offer you a 60-day waiting period or a 30-day, or some plans may even offer a 0-day elimination or 0 waiting days. But just remember, much like your auto insurance, the lower the deductible, the higher the premiums. You only have to satisfy us once in your lifetime. So if you get sick, go through your waiting period, you get better. 5 years down the road, if I get sick again, I've already gone through my waiting period. We don't pay traditional long-term care benefits during this time, except for hospice and respite service, or if folks take advantage of what we call the stay-at-home benefit. And the stay-at-home benefit is a separate pool of money, does not reduce that maximum lifetime benefit of your pool, and it is 30 times your daily benefit amount. It's a separate pool that's designed, again, to help you stay at home. It'll pay for things like durable medical equipment. I could stay at home, but I need a hospital bed. Home safety checks. Mom and dad lived in that house for 50 years. Is it still safe for them? Can we get mom and dad to 1-floor living? Home modifications. Can we get someone to come in and add a wheelchair ramp or a stair chair, or remove tripping hazards? Emergency medical response system. We all remember that poor woman had fallen and couldn't get up. If I had one of those, could I stay? Because again, and I'm sure that I sound like a broken record, but the goal should be to help folks stay at home. Care coordination. This does tie in a little bit to one of the earlier questions. So everyone who gets who has a need for care, once you're in the program, gets assigned to care coordination. It's a group of registered nurses who've worked in long-term care who are there to help assist in, most importantly, designing your plan of care, helping you find caregivers, helping with long-distance caregiving. So if I need to find a facility for mom, and mom has the federal plan, I live in New Hampshire, mom lives in Florida, how are we going to find a provider for mom? I can use care coordination. So it's another tool that will help you in the long-term care planning process. International coverage, kind of touched on this briefly. You can use the federal plan anywhere in the world. Anything that you're eligible for in the States, you're also eligible for overseas. There's also no war exclusion. War exclusion means that if someone needs care because they were either hurt or because their condition was due to an active war, declared or undeclared, then private insurance plans often don't have to pay those claims. That's not the case with the federal plan. So this is the newest feature change for the 3.0 federal plan. That is the Premium Stabilization feature, or PSF for short. And really the whole point of the PSF is to help mitigate the need for future rate increases, because it's an adjustable dollar amount that is calculated as a percentage of premiums you've paid into the program. And this amount is adjustable based on the health of the program. The plan is doing very well, the PSF will be a higher percentage than if the plan is not doing well. It's designed to work as a shock absorber and help reduce that need for rate increases. What you can use the PSF for, so what this separate adjustable dollar amount is, to offset future premium payments once we reach a certain age, or probably more importantly, it can be used to provide a refund of premium at time of death if you never use your benefits. Because I got that question all the time. What happens if I never use my long-term care insurance? I'd say, well, that means you didn't have a long-term care issue. That's kind of a good thing. And now I can also let them know that if you never use your benefits, you can have some premium returned to a beneficiary as a death benefit. So it's an additional feature that just came out on the last iteration back in last October. However, it's important to note that it's still a long-term care policy. We cannot guarantee premiums. No long-term care insurance can guarantee their premiums. Your coverage is guaranteed renewable. Your premiums do not change because you're getting older or less healthier. The only time you're going to see a change in your premiums if you decide to purchase more insurance, or if you're part of a group, the actuaries determine, we're concerned that in 20 or 30 years, there might not be enough money in the pool to pay claims. We have to institute some rate increase. We've been around since 2002. Over that time, there's been 2 rate increases for enrollees. The new PSF is designed to mitigate that need, but we cannot guarantee that. No one knows, again, what the future holds. The benefit with the federal plan is that we cannot raise rates without the approval of OPM, as we are part of the federal benefit system. So we are just like your FEHB, just like your FEGLI, just like your FedVIP, or we're one of your federal benefits. We're the largest group long-term care policy in the country. John Hancock is the current underwriter. We're the only plan that's sponsored and overseen by OPM. There are other long-term care insurance plans that will market towards federal employees, but we are a plan that is part of your federal benefits. The premiums are held in an experience fund separate from John Hancock's other assets, meaning that we cannot do anything with those premiums except pay for claims or for the cost of running the program itself. And if John Hancock decides to leave long-term care insurance, well, OPM simply picks up the fund, they find a new provider. So there is some additional security there. Performance metrics, that's really how John Hancock makes their money. On the plan, we only get paid that pre-negotiated profit if we do a good job running the program. So just a couple more slides. We're going to get through these, and then we'll be happy to answer any questions that you guys have. Some of these we've touched on. Rates are based on your age at time of application. However, long-term care insurance is still a medically underwritten program. So you do need to be in good health at time of application. It is not a guaranteed issue like your health insurance. Everyone applies individually. On the next slide, I'll show you the eligible family members. Your coverage is fully portable. If you leave federal service for any reason, you take the insurance with you. It's meant to be used down the road. And qualified relatives can apply even if you don't. We'll talk about them on the next slide. And you can apply at any time. Now, the underlying question is, well, when's the best time to apply for long-term care insurance? My answer has to be when you're still in relatively good health. But I understand the question, and I like to let folks know the facts, and they can make their own decisions. The average age of a new enrollee for the federal plan is right around 55 years old. That fluctuates. When the plan started, it was a little bit older. I'm 45 years old. I do not have a long-term care insurance policy yet, but that is because I have a young daughter at home. So our extra insurance dollars go to life insurance. Something happens to my wife and I, we want to make sure she's taken care of. Someday, knock on wood, she'll be financially independent and out of the house. Maybe I don't need to carry as much life insurance. So it's going to be different for everyone. It's important just to remember about that medical underwriting that you're applying before that need for care or a condition that might cause a increased need for care. There are some conditions that would make you automatically disqualified. There are some pre-existing conditions that would mean that you're not able to get insurance. If you have a question about a pre-existing condition, the best way to get it answered is either to call us and we can tell you, or on our website, you can download a copy of the application. You don't have to apply. You don't even have to put your name or your agency. Just download a PDF of the application. It'll list what the auto disqualifiers are. As long as you can say no to those, then you're certainly eligible to apply. Just quickly, eligibility, employees and annuitants. So the biggest difference between us and FEHB is, you do not need to carry this for a certain amount of years before you retire in order to be eligible. Your qualified relatives would be spouses, domestic partners, adult children, but also parents, in-laws, and step-parents of employees. Once you retire, your parents, in-laws, and step-parents are unable to apply brand new. They don't lose their coverage, but they have to apply when you're still in the workforce. And I think I mentioned this in the last screen, but these folks are all eligible, but I'm not buying a self plus one or a self and family. My spouse is eligible, but she has her own plan. Her rates are based on her age. Resources, ltcfeds.com is the website. Of course, if you Google federal long-term care insurance, it will take you there. If you go to OPM's website, it'll link you there. We have a tremendous toll-free number, 1-800-LTC-FEDS, 1-800-582-3337. With their 8 to 6 Eastern time. Like myself, none of those folks work on commission. So they're just there to educate about long-term care and long-term care planning. They will not be calling you at supper time to ask you why you have not signed up yet. I'm a little biased because it's how I got my start. And I ended up managing that group for a couple of years before I worked directly with agencies and affinity groups. But please utilize these folks. And I do like to share 2 quick things about our toll-free number, because I know folks are hesitant these days to call toll-free. I had to call the cable company last week. I get it. Part of our contract with OPM is that we answer at least 85% of our calls within 20 seconds. And then once you call that toll-free number, it's one button, option number 1, and within 20 seconds, talking to a real live person from the beautiful seacoast town of Portsmouth, New Hampshire. So last thing, last 2 thoughts on long-term care, then I'm happy to answer any questions. I think we've alluded to this, or I've alluded to this in the presentation, but long-term care insurance is not for everyone. Federal long-term care insurance plan is not for everyone. But the idea of having a plan, whether that's insurance-based or not, is absolutely for everyone. Because we would all like to believe that these kind of situations are going to bring your families closer together. I can tell you that is not always the case. And the reason is because someone always thinks they're doing more than somebody else. This is a very challenging discussions to have with your loved ones, but I can guarantee with just about 100% certainty, it's a lot easier to have when everyone's well than when someone's sick. Medical power of attorneys, if mom's sick, is there someone that can speak on her behalf? That's another really challenging conversation to have with mom. She doesn't think she needs to worry about it yet. She's healthy, she's living independently. Well, it's a conversation you don't want to be having in front of a judge. I make a very personal, so not connected to the federal long-term care insurance plan, but there is a document called 5 Wishes. You can Google this. Aging with Dignity is the organization that puts it out. I believe they charge you $5 to send you a copy. It's a legal document in 44 states, and it walks you through the questions we should be asking about end-of-life issues. We as a society do not do a great job of discussing end-of-life issues. And the most important tool about 5 Wishes, or I think the biggest benefit, is it means that everyone's on the same page. Because you might think that you know exactly what mom's wishes are, and you might be 100% correct. But if you have siblings, if you have 2 sisters, and they think they know what mom's wishes are, and they're not the same as yours, your relationship with your sisters will never be the same. I've seen it happen in my 15 years in long-term care. If you're looking for long-term care insurance, the federal plan is an excellent plan. going to be there for you because of the federal affiliation. But hopefully the takeaway from today is less about running out to buy insurance and more about just making sure that you and your family have a plan should you have long-term care needs down the road. So Dolores, I think I went a little lengthy at the end of the presentation, so I apologize, but I'm happy to answer any questions. And again, if folks don't get their question answered today, the toll-free number is also a great resource.
Well, thank you so much, Nathan. Yeah, we'll try to plow through. We have quite a number of questions. The first is there are a cluster of questions about spousal
Sure.
insurance, and they center around whether there's any benefit for the spouse and the employee to be on the long-term care program together, and then how do you determine what the premiums would be? Would the
Sure.
spouse need to take an individual medical test, or
Yeah.
how does that work?
So, so in order to apply, everyone with the federal plan, everyone has their own individual policy. So I have a plan, my spouse has a plan, and my rates are based on my age. I fill out my own application. My spouse, even if she's not a Fed, fills out her own application. Her rates are based on her age. There is no connection at all between those policies. I think probably what folks are referring to, is what is called a shared care benefit. A shared care does exist in the private market. It is where my spouse and I share one pool of money, so that if she needs more care, she can use more of that pool than I can. The federal plan does not offer that. How it's been explained to me that back when it was created in 2002 is that was seen as a benefit that was offered to couples that couldn't be offered to individuals. Therefore, OPM was very concerned about fairness and equity. So it was not included in the original iteration, has not been included since. Could that change? It might, but I have no reason to believe that it'll change anytime soon. So if that's a benefit that's important to you, you would want to, maybe look outside the federal market for that. Pros and cons. I mean, it's sort of the same. The biggest con is, well, what happens if one spouse uses all the money? But the pro, if you will, well, that means that one spouse probably needed more than what they would have chosen for their fair share if you bought individual policies, and they were able to still get some benefits. So it's really a personal decision. It's probably going to come down for most folks to price point. Federal plan is the largest policy. Usually it's going to be a little less expensive, but private plans, if you're buying plans for a couple, sometimes that is where you can see some cost saving. So again, I always recommend folks do their due diligence to find the plan that best meets their needs.
Okay, Nathan, thank you. There are a bunch of questions clustering around the metrics. What do you look at? What kind of stats do you look at when you're considering this? And the first is, of all the people who purchase long-term care insurance, what percentage actually benefit from it?
It's a great question. I don't know if I know that answer because it's still a relatively young program. I know that we have around fluctuates anywhere from 270 to 290,000 enrollees at one time in the federal plan. I know that we paid over $1 billion in claims in the federal plan, but as far as what percentage that is, I don't have that in front of me. I can see if I can find it, Dolores, and get that to you. I can tell you that just if you're looking at percentages, about 50% of claims are for care that's received in one's own home. Only about 12% receive care in nursing homes. So again, it does help with that community-based care. But I don't know the exact percentage. I think a lot of that's because, it's such a young program. A lot of folks that have purchased it are just not at that need for care yet.
Okay. Sort of related, what kind of calculation would go into, if you can answer this question, whether you can forego long-term care altogether and just self-fund? I mean, how much money do you need to think about that reasonably?
Sure. So what I would suggest, so we have a tool on our website that's called a guided planner tool, and you do not have to put any information in to use the tool. So I'm not sending you there so that we catch you and we can email you all for the rest of your life. You don't put any information in. You can just use the guided planner tool. What you can do is you can put in what your where it is that you want to choose for receiving care. It'll ask you some questions. It'll tell you what the cost would be. If I needed 4 years of home care and 2 years of facility care, that should cost me X amount of dollars in today's dollars. Okay, now I have that amount. I'd say, well, is that something I can comfortably spend? You just want to make sure you're thinking about inflation, which in all honesty is a little bit lower with long-term care than it is with traditional medical care, because long-term care is still very hands-on care. It's not a lot of advancements in technology that's driving the price. So it stays pretty low, it's usually somewhere around 2-point-something% a year if you're looking at nursing homes, for example. So you just want to make sure that wherever that pool is, that's going to be a comfortable amount for you to be able to pay out of pocket. It's definitely a middle market plan. If someone has no income or assets, don't buy long-term care insurance, because there are other things that Medicaid will take care of folks. If you have a lot of income and assets, you can probably self-fund. It's for those folks that are either caught somewhere in the middle or have specific plans for things like the lake house that I want to make sure stays in my family, or I want to protect the townhouse in Georgetown, or is there certain assets that you're looking to protect? Maybe even if it's a small long-term care policy that just equals that asset, so that's not something that has to be in play should you need care for extended periods of time.
Nathan, would you repeat the website that you're talking about where this?
Sure, it's LTCFeds.com.
Okay, that's probably in your PowerPoint somewhere.
Yeah, it's right on the last screen on the thank you. And then again, if you just Google it, or if you can link directly from OPM, and the guided planner tool is right in the front. And and one other thing I sound like a broken record about, again, you can just enter. You don't need to enter any information. So it's a tool that you can use to educate, even if you're not going to buy long-term care insurance from the federal plan.
Nathan, is there any other metric that people can use when they're trying to determine how to build their plan? I heard you say that the U.S. average stay in a nursing home is 2.5 years. Is that metric changing because a lot of people are trying to age in place? I mean, what other metrics can people really look at besides that and the longevity of their family and their health?
Yeah. So I think the most important thing that folks that are federal annuitants, federal retirees, what I would recommend's a tough word because I'm not an insurance agent, but what I would suggest that you start by is certainly not over-insuring. So what I mean by that is, if you look at what the cost of care in your area is or wherever you think you might use the policy, try to think about what your retirement income is going to be. Because most folks are less concerned about, if I need to be in a facility, I'm probably okay with my pension paying for that facility. But what I want to prevent is having to spend down my assets. So if I know that the cost of my care in my area is X amount of dollars for a nursing home, but I know that my pension would cover a certain percentage of that, I would not recommend anyone insure for that percentage that will be covered by your pension, because that's income protection. Most folks just need to worry about asset protection. So that's one thing I would look at. A lot of folks tend to overinsure themselves. They buy much more insurance than they need. When you want to think about you're going to have income, what's that income? Subtract that first. What we call kind of like, gap insurance, making sure that you're figuring out the gap so that, your TSP, your lake house, the house the townhouse, those are the things you're looking to protect. That's where I would start.
Okay. This is related. Can you say anything about the standard profile of a person for whom private insurance is better than the federal program?
Yes, I mean, it behooves me to say the federal plan is always better, but so again, it's going to come down to price point for most of us because most plans are going to work about the same. Some additional flexibility with home care, but it's going to come down to price. We don't do any medical rating. So when you're looking at your federal plans online and you put in your age, those rates are the actual rates you'll pay, assuming approval health-wise. Once you meet that minimum threshold of health, you do not pay more if you're less healthy. You don't pay less if you're more healthy. So where the private plans would possibly make more sense would be that if my spouse or partner, we're both applying at the same time, they will probably offer some sort of spousal discount. Like if we get you both in today, we'll take 20% off one of your policies. And if you're both in really, really good health, so you get that additional bump or subtraction of premium, because private plans will do rating. So if we're really healthy, we're a couple, we buy a plan, you might see some cost savings that way. If you're an individual, you probably won't find a lower rate than the federal plan. So individuals, regardless of your marital status, but if you're applying just by yourself, probably the federal plan be less expensive. What we're seeing in the private market now too is gender-based pricing. So, when I was 16, I paid more for my car insurance than my sister because I was much more likely to put their car into a tree than she was. If my wife and I are shopping in the private market and we are the same age, she will pay more for her insurance than I will because she is much more likely to need long-term care based strictly on her gender. So individual females, I have not seen a lower rate than the federal plan. That's really where it's hard to find a comparable plan price-wise. But again, couples in good health, both buying at the same time, if that's your situation, I'd recommend shopping around in the private markets as well then, yes.
All right. We have one questioner who's thought that perhaps females in the non-federal plans had cheaper rates than the federal plan, but you're saying that's not correct.
That has not been my experience at all.
Okay.
Again, just because they're much more likely to need it, unfortunately.
Right. And back to premium increases, I'm not sure how much you can say about this. I know you've touched on it, but is the expectation that the premium increase is going to be large after the 7-year period?
Well, the expectation, the goal would be to mitigate that need with those. That's really what OPM's goal was after the last rate increase. That's why they created that PSF with John Hancock. So I do not know what the future holds of rate increases. My very honest answer that I tell everyone in every presentation is that, again, I'm 45 years old. If I bought a plan today, I need to tell I was 85. Do I think in 40 years I might see some sort of rate adjustment, even with the PSF? It's probably a pretty strong possibility of that. I think that as these plans get more mature, the actuaries have a better understanding of how they're being used, and you should see less fluctuation in rate increases. And hopefully you don't see giant rate increases like you did in the earlier parts of the program. But unfortunately, that's just not something that I can guarantee. And to the best of my knowledge, there's nothing planned. Whether that changes with the contract, I just know that would be an actuary and an OPM decision.
Okay, we're still on money, and I'm trying to rush through. We might be able to control this.
Yeah, it's important.
The return of unused premiums in 3.0
yes.
that you mentioned, will that principle also hold for the 1.0 and 2.0 plans retroactively?
Unfortunately, no. That new feature is included in the cost of the 3.0 plan. If you have a 1.0 or a 2.0 plan, you can always call this same toll-free number, 582-3337, 1-800. They can walk you through what the pricing change would be if you want to move to 3.0 and that whole process. Whether or not, I think once you've had the policy for more than 5 years, I think it's going to be a tough sell as far as cost because you're 5 years older, looking at a new program. Might make sense to stay with what you have, but they can walk you through what those cost changes would be.
All right. And once you sign up, can you reduce the amount if you think that you have overinsured yourself?
Yeah, absolutely. You can always increase or decrease your plans at any time. Don't have to wait for any kind of open season. If you decrease coverage, it's simply a phone call and we reduce the rates, and the rates are always based on your age of sign up. So if I'm 50 and I buy one amount and at 65 decide to reduce it, the rates are still based on a 50-year-old. I can purchase more insurance as well because I'm buying something at a higher age. Then there is a rate fluctuation where they're going to blend the rate between my original age and my new age. but you can increase coverage as well as decrease at any time.
Okay, I'd like to segue a bit into health conditions. You've touched on this.
Yep.
Is there anything you can say about what health conditions would make you ineligible
Sure.
for long-term care insurance?
Yeah, I mean, it's surprisingly, it's a lot of ambulatory issues. So if someone's already using something like a walker or a wheelchair or a motorized scooter, if someone has a diagnosis of something like MS or Parkinson's, if you have an assumed diagnosis of Alzheimer's or dementia, if I've had multiple strokes, those are sort of the basic idea of the types of things that would make someone not eligible. If you have something like heart disease or high blood pressure or cholesterol, cancer in remission, these things are not auto disqualifiers. Underwriting may review your record and make a determination. If you have this plus this plus this plus this, that might unfortunately be a disqualifier. But those types of issues that seemingly we all have are not automatic disqualifiers.
Okay.
But there is that list on the website, downloading the application, it does list the automatic disqualifiers so that someone doesn't have to go through the process of applying if they have one of those auto DQs.
I'm going to try and sneak two more through.
Okay.
What do you do if you have a disqualifying condition? Do you have any advice for someone who's in that situation?
Yeah, I mean, first of all, always take a look at what the current underwriting standards are. People that have applied 10 years ago because of a condition, it could be that underwriting has changed in those 10 years. When I started, you had to be cancer-free for like 4 years, I think, before you could apply. That is no longer the case because there's no correlation between cancer and an extended need for long-term care. So always just make sure that you're checking. Unfortunately, if you have something like MS, I can't imagine that will ever be something that you can get long-term care insurance through the federal or private market plans. And then you have to see if something like if you could add that rider to your life insurance policy. If you look at private annuities, if you're lucky enough to have some upfront cash, you could look at annuities that are going to pay you. They have medical annuities you can pay. Unfortunately, it's usually a pretty high upfront cost, but there are things. A lot of it's going to come down to planning with your family. State Department of Aging, not just for finding facilities, but they have a lot of good tools and resources for assisting. But unfortunately, for long-term care issues, there's just not a lot of answers for folks that are already disqualified, even at younger ages.
Okay, now this is kind of back to basics, but just to make sure, in case someone wasn't present during this part of your presentation, could you go over what the long-term care program covers? Does it cover the CCRP? What exactly does it cover? What flavors of long-term care?
Sure.
Just to kind of.
It's pretty easy these days. So with the federal plan, again, we offer that comprehensive coverage. So really, we will cover any cost of custodial care, regardless of the location. So if you've bought into a CCRC 10 years ago, and you've already paid your $1.2 million, and that's where you are, and you're not going to see any additional costs, then you could not use long-term care in that situation. But let's say that I'm currently in independent care at a location, but in order for me to receive care for helping with some of my activities of daily living, there's an additional cost for that. That additional cost could be covered by my long-term care insurance. If I'm receiving care at home, that can be covered. Facilities like assisted living or nursing home can be covered. Daycare, like community-based adult daycare is covered. Any location that is there to help you receive care that's custodial in nature for those ADLs or because of cognitive supervision, it will be covered by long-term care insurance.
Okay. All right. One more. Then
All right.
This is sort of philosophical. Why is the long-term care program marketed to those approaching retirement when one might have been in an accident or had an illness that requires long-term care earlier than retirement age? Presumably having a predominantly elderly pool of insured people raises rates for everyone.
Well, I mean, we certainly market, we as an organization market towards all federal employees. I can tell you from doing new hire briefings that I've sat in the room with 25-year-olds and physically watch their eyes glaze over as I talk about long-term care insurance, because they just don't see the value of it. We do get some pushback from agencies. We don't get invited to all mid-career, the State Department actually is one that does invite us to the mid-career events, so we do speak at State Department on mid-career. But I think it's that people have limited dollars they can spend for insurance. And a lot of those folks, like I said, my situation, really all I'm focusing on now for the next couple of years is making sure that our daughter's taken care of. And maybe that is, like you said, philosophically a little bit short-sighted, but it's our most important insurance need right now. So I think that it's less about people, they don't see the value. They just don't see the value of it because they think none of us are ever going to need this until they see their family members going through it or until they have a situation. And then we just have limited insurance dollars between our health insurance, between our life insurance, between our vision and dental insurance. There's just usually not enough dollars, to go around. So I think the shorter answer is when we market to younger folks, they don't see the value in it. And if that's us not doing a good enough job marketing, it's probably part of it as well. And then it's just the limited amount of insurance funds that we all have today.
Right. All right. Well, Nathan Siebert, thank you so very much for sharing all that information on a very complicated topic. It certainly has been enlightening. I also want to thank all the AFSA members out there for being AFSA members. And if there's any questions that you have or feedback from me or anything I could pass on to Nathan, please don't hesitate to be in touch at brown@afsa.org. Have a great day. Hope everybody is in good spirits, and thank you. See you.
Thank you very much, Lois. And again, if you have any questions, please don't hesitate to reach out.
Okay. Thanks, everyone.